Hey everybody, Mike Potenza, and we are back to wrap up this first module. And the topic right now, business fraud. Fraud's a bad word. It's a nasty word. Fraud means someone is intentionally trying to steal from someone else, all right? Fraud is no good. But we have to know how to identify fraud and what are the different schemes people could try. So let's dive into business fraud. First thing I want you to know about fraud, there's two main types of fraud. There's what we call fraudulent financial reporting, or lying about your business financials. There's also misappropriation of assets, which is stealing from a business. So we're going to focus on these two. Let's start with fraudulent financial reporting. That's the first thing. So think about anytime someone intentionally makes misstatements in financial statements, or maybe they omit important information from those financial statements. Well, it could be related to dollar amounts. It could be related to informational disclosures that should have been made and were not made. All of this inside of the financial statements. So think about this. What are people lying about? They're lying about dollar amounts, or they're lying about disclosures. Where do they lie about them? In their financial statements. And why are they doing it? Because they want to trick people. They want to deceive people so they can steal from them. All right. So that's the really bad thing about fraud related to financial statements. So what are some examples of this we should watch out for? First one is anytime someone manipulates or they falsify or alter any types of records that could impact the financial statements. That is not good. All right, think about forging fake invoices or writing fake checks or, forging bank statements, dollar amount changes, things like that. All of that is a type of could be related to fraudulent financial reporting. What about misrepresenting dollar amounts or intentionally omitting informational disclosures, right? That's a big problem as well. So imagine you took money from a business credit line and you deposited into your operational checking account and you stated, oh yeah, this is revenue, this $100,000, we made a big sale, and you're trying to show it as, revenue for the business. But meanwhile, you just took it out of your credit line. You cannot do that, right? That is fraud, and that is no good. Or what about intentional misapplications of accounting principles? Think about LIFO versus FIFO, right? Maybe a company is supposed to be using FIFO, first in, first out, when they sell goods. And we know first in, first out, the first in have the smallest dollar amount. So if you take the sales price minus the cost using FIFO, it's a lower cost. LIFO is newer inventory, so you probably paid more money for it. So what happens is when companies don't want to pay taxes, or they don't want to pay as much tax, they'd rather have a higher expense because you take your sales price minus your cost, right? Whatever it cost you to purchase this inventory. So if they switch between LIFO and FIFO when they're not supposed to do it, just so that they show less profit, so they pay less tax, again, that's a type of fraud. You have to watch out for that. All right, now let's talk about misappropriation of assets. This is when we steal from businesses, all right? So when we talk about theft, we talk about stealing, we talk about misappropriation of assets. We just call it stealing, all right? It's misappropriation of assets. Just a fancy way to say you stole something, all right?